Hello, everybody. Welcome to Wiley Solution Walkthrough. This is Accounting Tools for Business Decision Making, 8th edition. We're going to go ahead and do two for the price of one. Exercises 24-5 and 24-6 for standard costing. The question used in the presentation is copyright 2022 by John Wiley and Sons. The textbook authors are Paul Kimmel, Jerry Weinand, and Jill Mitchell. All rights are reserved. This is for educational purposes only. The video may not be distributed, or redistributed without the express permission of Wiley. This presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of myself and not the authors of the textbook or of Wiley. Let's have some fun before we thank that bus driver. Okay. So the first one for exercise 24-5. Okay. So this is over here, and we're talking about materials variances. So when we look at what goes into the components in our WIP account, right, what do we have that goes in? We've got Demon Master, direct materials, direct labor, and then we're going to have overhead, which we'll call variable overhead, and then fixed factory overhead. What we're trying to go through and do is we're trying to develop standards so that as we're going through and in production, we can basically go through and determine, are we going to have any kind of, production issues? Are we overspending on things? And if we are, do we need to increase our prices? So when we look at direct materials, how do we go through and set up our standard, or how do we go through and determine if there's any variances with our standard cost? So the way we're going to do this is for direct materials, we're going to basically come over here. We're going to take our actual quantity times the actual price. And the actual quantity times the actual price, this is going to give me what we spent. Okay. Now over here, if I take the SQ, or the standard quantity, and I'm going to have the standard price over here, basically SQ times SP. This is what we should have spent. So we're going to call this what we actually spent. So the first thing we want to do when we're approaching any of these different types of questions is to say, what is my total variance? And the total variance can be defined as my AQ times AP minus the SQ times the SP. If the number is positive, meaning I spent more than I should have, that's going to be viewed as unfavorable. If it's a negative number, meaning I spent less than what I actually did, it's going to be viewed as favorable. Okay. So for Farrell, it includes the standard cost, the product B, includes 3 units of direct materials at $5 per unit. During June, so this is the actual number. So 29,000 units of direct materials are purchased at a cost of $4.70 per unit. So the amount I actually spent over here is going to be 136,300, right? So this is what I actually went through and spent. So what I wanted to go ahead and do is I want to try to compare this. Well, how much should I have spent, right? So if I actually spent 136.3, how much should I have spent on this, particular on basically for this production run? So as I look at this over here, well, it says that we produced 9,400 units of product B, but for every unit, I need to use 3 units of direct materials. And you always want to, this is where it can be really tough. So this is going to be 9,400 units produced times, and my standard is going to be, so the standard cost is 3 units. So my total quantity is going to be 9,400 times 3, or 28,200. And my standard price over here is going to be at $5 per unit. Now, what's interesting about this is I already know just by looking at this. So again, 28,200, where did that come from? Well, it's 3 units of direct materials, and I produced 9,400 units. So my standard quantity is going to be 28,200. My standard price is over here at $5 per unit. So the amount that I should have gone through and spent was 141,000. And if I look at my total variance, it's going to be 136 minus 141,000. So my total overall direct materials variance, or total materials variance, and this is going to be favorable. Why is it favorable? I only spent 136.3. I should have spent 141,000. Now, to further go down and isolate this, right, what we now want to go through and do is we're going to put in our middle value. What's the middle value? It's the actual quantity times the standard price. And when I put in that actual quantity, right, so my actual quantity was 29,000. So my actual quantity over here was 29,000, and my standard price over here is at 5. Now, when I'm looking at this middle value, why do I have this middle value? Well, this allows me to go through and to isolate the price and the quantity variances. Why? The first one we're going to look at is the price variance. And this is going to be my actual quantity times the actual price minus the actual quantity times the standard price. And this over here is going to be negative 8,700. So this is going to be my materials price variance. And this is going to be favorable. Now, why is this the price variance? Well, what am I doing over here? By comparing these, when I compare these two numbers, what am I keeping constant? Well, I'm keeping the quantity constant. Therefore, I'm able to isolate the pricing variance. And so over here, this is my price variance. And why is it favorable? Well, I only spent $470 for the direct materials units, whereas I should have spent $5 per unit. So I actually came in below that. So let's look at the other one. For this one, it's going to be my quantity variance, or how much should I use? And this is going to be my this is going to be my actual quantity times my standard price minus my standard quantity times the standard price. And again, what you're going to notice over here is, because if I'm comparing this number here to here, what's constant? Well, my price is constant. So therefore, I can focus on the actual quantity that I went through and used. Now, when we look at this over here, the number is positive. Well, is that a bad thing? Well, it kind of is, right? Because when we went through and actually produced the units, we used 29,000. We should have only used 28,200. So this is going to be an unfavorable materials quantity variance. All right, by the way, you can put materials quantity variance and favorable. It doesn't really matter. Okay. Now, the one last thing that I want to do before we move forward is I need to check my work. When you do these problems, you're going to go ahead and add up the two different variances. And so this needs to equal, the two individual ones needs to equal the total amount of the variance. Okay, let's go ahead and we're going to rinse, lather, and repeat. And we're now going to go ahead and do this for a little bit of a different scenario. So let's go ahead and put this over here. Okay. Okay, so now it says repeat A, assuming the purchase price is $5.15 and the quantity used is at 28,000 units. Okay. So now for letter B, it's saying, well, assuming that the purchase price is $5.15, okay, and the quantity being used is 28,000. So now over here, my actual spend is 144,200. Okay. I should have spent 141,000. So my total amount that I spent on materials is going to be unfavorable, right? Because over here, I actually spent 144. My standard is 141. Remember, they said, okay, well, now assume 28 and 515. So this is going to be unfavorable. Now, to do the same process as well, I want to go through and isolate the other variances. So let's go ahead and do this over here. So my actual quantity is 28,000, and then my standard price is 5. So when I come over here and I look at this, my price variance is going to be 144 minus 140,000. What is this going to be? This is going to be a total material, or my materials price variance unfavorable. Why is it unfavorable? I spent 515. I should have only spent $5. Right now, for my quantity variance, which is where I'm comparing this to here, this is going to be 140,000 minus 141. Well, in this instance, because I used only 28,000 when I should have used 28,200, this is going to be a favorable materials quantity variance. Okay. So how do we know we've done this correctly? I've got to add the two numbers up, and this has to equal to my total variance. Okay. So let's go ahead and now jump ahead to exercise 24-6. And so to kind of help us out, I'm going to go ahead and take a look at what I did back in 24-4. And in 24-4, we were kind of going through and looking at this, and let's just kind of give a brief summary in terms of what we went through and did. But when it comes to direct labor, what I'm really going through and looking for over here, just give me a second. Okay. So when I'm dealing with direct labor, it's somewhat the same, but it's going to have a little bit of different terminology. Now, Wiley they're choosing to go through and use labor price and quantity. And you'll see some other places say rate and efficiency, but it's the same thing. Rate is another word for price, and quantity is another word for efficiency. So you'll see it used in both ways, but over here, our goal is the same. When we're going through and doing these types of questions, what we're really trying to figure out is, well, how much did we actually spend on our labor, and how much should we have spent? So let's go ahead and do our first part, which is going to be figuring out what is the total amount of the variance. So it says Lewis's company standard labor cost for producing 1 unit of product, DD, is 4 hours at the rate of $12 per hour. So it's going to take me 4 hours to make 1 unit at a rate of $12 per hour. Now, here are my actual numbers. I use 40,600 hours at a rate of $12.15 per hour. So over here, the actual amount I spent on my direct labor is roughly about $493,000. Okay, so this is where that number is coming from. It was right over here during August. 40,600 hours of labor are incurred at a cost of $12.15 per hour to produce 10,000 units. That's what I actually spent. Now the question becomes, well, if this is what I actually spent, how much should I have spent? So to figure out how much should I have spent, I need to know my standard hours. What are the standard hours going to be? Well, if I produced 10,000 units of product to make 1 unit, it's going to take me direct labor. It's going to take me 4 hours to do it. So over here, my standard hours are going to be 10,000 times 4. So this is 10,000 units times 4 hours per unit for a total of $40,000. Okay. Now my standard direct labor rate, or my standard rate, is $12 per hour. So the amount that I should have spent on my direct labor is going to be $480,000. Okay, so this is how much I should have spent. How much did I actually go through and spend? Well, I actually went through and spent 493, basically 493,290. So my total direct labor variance is basically going to be 493,290 minus 480. This is going to be an unfavorable total direct labor variance. Okay, I spent too much. I should have only spent 480. I ended up spending 493. Now, similar to what we did up before, I'm now going to basically put in my actual hours times my standard rate. And this is to go through and to isolate what we call the rate or efficiency variance, or what Wiley is referring to here as the price and quantity variance. So over here, when I take my AH times my SR, my actual hours are 4,600. My standard rate is 12. So to making sure that we get to this total amount of my direct labor variance, what I'm now going to go through and do is say, okay, AH times AR minus AH times SR. This is going to be my direct labor efficiency / price variance. Okay. So over here, this is going to be 493,290 minus 487,200. This is because I spent more per hour than I actually did. Remember, I'm isolating the rate by comparing it to these numbers, right? So this is going to be an unfavorable rate price variance for direct labor. Okay. Now, to complete this, right, I'm not done yet, because now I need to figure out the efficiency or the quantity variance, which is going to be my actual rate times my actual hours times the standard rate minus the standard hours times the standard rate. This is going to give me a direct labor. This is actually direct labor. This should be a rate. Sorry about that. It should be a rate variance. This is going to be efficiency or quantity variance. I'm not perfect. So when I take 487.2 minus 480, this is going to be 7,200. So this is going to be an unfavorable direct labor efficiency quantity variance. How do I know if I've done this correct? I've got to add up my two variances over here, and I know I'm good to go because it equals the total unfavorable amount. For this one over here, when I'm comparing I'm isolating the hours because I'm using standard rate in this part. By going through and isolating through the hours, I used 40,600 hours. I should have only used 40,000. Okay, so that's the first part over here. And now we're getting a new scenario. Okay, so let's go ahead and we'll just go ahead and copy this down. Okay, so our new scenario is repeat B, assuming the standard is 4.1 hours of direct labor at $12.25 per hour. So if I use over here $12.25 and I come over here and I'm changing my standard hours now to 4.1, this should be 41,000 hours. Okay. So over here, what I'm doing now is I'm changing my standard hours. So it's saying repeat B, assuming the standard is 4.1 hours at a direct labor rate of $12.25 per hour. So when I come over here and look at this one, this is now my new standard, right? So the first thing I want to go through and do is I want to go through and compute what is the total variance. Well, if I use 41,000 at $12.25, I'm going to come up with 502,250. I compare this to what I actually spent. This didn't change. This is going to be 40,600 times 1215 is going to be 493,290. So because I spent less than what I had budgeted, this is going to be a favorable total direct labor variance. Okay, now I want to go ahead and put my middle values in. Actual hours times the standard rate. So what I'm going to do here is I'm going to go ahead to do the rate or the price variance. I'm going to compare right over here, 493,290 less 497,350. Because I'm isolating when I'm comparing these two numbers, my hours are staying the same. I'm focused on the rate. This is going to give me a favorable direct labor rate price variance. Okay. Over here, I'm taking the actual hours times the standard rate minus this part over here, or the total budget. But because I'm showing the standard rate as being the same, I'm able to go through and to isolate the hours. So this is going to be a favorable direct labor efficiency / quantity variance. Okay. So remember, when you're at home, and the last thing I want to do is check my work. When you get these questions on, pretty much any exam, right? What do I want to be going through and making sure that I'm going through and doing? Well, the first thing I would suggest to you is to figure out first, what is the total amount of the variance, right? What's the total variance? Because that number, right, is going to be what you're going to have to, when you get down to the components of it, that's what it's going to have to equal to. When you're figuring out the total amount of the variant, when you're doing the total variance, usually the hardest thing to do is to figure out, well, what is going to be like the standard hours or the standard quantity in terms of materials, right? Why is that? It's not that it's necessarily overly hard to do. It's just that sometimes it can be tricky in terms of whatever the standard amount is. You're going to want to take the units produced times this. Then over here, when I'm looking at the actual amount, so I'm going to go ahead and compute the total amount. Then I'm going to put in that middle value. I'm going to go through and compare it, and that's going to help me lead down to my rate / price variance, or my efficiency or my quantity variance for direct labor. Or if I'm doing this for materials, it's giving me a materials price and quantity variance as well. So, and then the last step, you want to make sure that as you add up these over here, that they equals the total amount of the variance. Remember also, you want to use common sense. What do I mean by that? If I'm spending $12.15 per hour and I budgeted $12.25, I spent less. So therefore, it's going to be favorable. But if I used 40,600 hours and I should have only used 40,000, I know right over there that efficiency quantity variance is going to be unfavorable because I spent too much. So again, just try to do it a little logic. Of course, practice and repetition always helps. And again, I really want to thank Wiley for allowing me to make these videos. I look forward to seeing you on the next one. Have a great rest of your day.